Hey, Peter.
Okay, thanks everybody for joining us. We're going to start our webinar in about 9 or 10 minutes. So thanks for coming early, and we'll start right on time. On the Google Hangouts, I think there's just to make sure that you can hear me. There's a live button on the top hand side, on the right hand side, and there might be depending on your computer, a red button in the bottom of your screen. So if one of those is on, you should be able to, things should be working fine on your end.
Great, looking forward to it. Almost time to go.
Okay, we have some people checking in. So hi George, hi Dwight, hi Rob. We've got quite a good attendance on today's webinar. I think we're almost sold out according to Lana, but I'm not too sure what sold out the number was. But I think we have close to 1,000 people who have signed up, and hopefully we can tell you all about dividends, how to make some money, how to save some money, which is just as important to making money, and what to watch out for. We've got somebody with the name of MHOG, so hello there, wherever you're from. It doesn't actually indicate where you're from on our screen, so thanks for joining us. And since we're about dividends, there was I always like to open up my Bloomberg every morning and see who's paying a higher dividend. So today when I woke up, it was George Weston with a kind of an anemic 1.2% dividend increase, but sure, it's better than zero, so we'll take it. And also, there was another one. My brain is hurting me right now. I can't remember who it was, but
don't think too hard before we start, Peter.
Yeah, I put it on our Twitter feed, so just once it's on Twitter, I forget about it. But oh, now it's killing me. I'm gonna have to go back to Bloomberg and find out who it was, since I started talking and I couldn't actually finish my statement here. Well, there's all sorts of U.S. companies that have done it, but we're just focused on Canadian primarily.
Well, BCE had their earnings out today too, I believe. They did very well.
Yep, they did. Yeah, they were fine. There was some problem with the wireline business, which is the home phone business. So I can't imagine a lot of people are actually signing up with new phones for the wireline business when they could just go with a cell phone. But the numbers weren't too bad. Company called HNI in the U.S. increased their dividend 4%. We had MKS Instruments in the U.S. increased their dividend from 16 cents to 16.5 cents. Nothing dramatic. Delta increased their dividend, and that was from to 9 cents from 6 cents. So that's a pretty big move in terms of percentage-wise.
Actually, that was an interesting trend today. The airlines are actually doing very well, and they're actually profitable enough to have even increased their dividend. I can't remember the last time they were able to do that.
I agree. They're usually pretty bad investments, at least in Canada.
Yeah, actually, I look at WestJet, and I mean, I looked at Air Canada when it was, what, $2 or $3 a share, and went, oh my goodness.
Air Canada always scares me, of course, because any company that almost goes bankrupt twice has to be a little bit suspect.
Actually, sometimes when I go to conferences, I have to book on Air Canada, and I'm like, oh goodness, please don't go on strike, you know? Well,
maybe my brain's really hurting, because I've gone all the way back to 6:30 this morning. I still haven't found my Canadian company that increased their dividend. So there's a company called Infineon in the U.S. increased their dividend.
The question is, though, are these companies that can actually afford to raise their dividend, or are they just doing it for appearance?
Well, that's interesting you say, because some companies do it to offset bad news, and we've seen that quite a few times where their earnings have just been horrible, but they'll throw a small 4 or 5% dividend increase at you just to kind of make it look like everything's peachy when it really isn't. So that's one of the things to watch out for.
Absolutely.
Okay, I found it. It only took me 10 minutes. It was New Alta. New Alta raises their dividend by 14%, so that's a pretty big boost for for an oil service environmental company. It's not a bad move. There we go. And that, you know what? There was we have somebody online named Greg who got it way before me. And sorry, when I was looking at Bloomberg, I was off the screen. So thanks, Greg, for telling me what I should have known 5 or 6 minutes ago. The site, someone asked me where I'm getting this information. At 5i Research, we subscribe to Bloomberg Professional. It costs us $3,000 a month, but it tells us pretty much everything in the world that you would ever want to know about any stock, anywhere, anytime. And we really couldn't run our business at all without it. Bloomberg has got some free services, but in terms of dividend increases, we've actually had a very hard time finding out a good free source of dividend increases and dividend news. The TSX puts out this information, but sometimes it's incomplete in terms of what they release on their website. All the companies actually will press release their dividend increases, but because of the way the newspapers have changed, they generally don't pick up that information unless it's a really popular stock like BCE or a widely owned stock that's raised their dividends. So we try and go through Bloomberg every morning. We put it on our Twitter feed. Every once in a while we'll miss one because sometimes they kind of just sneak in there, and if there's something else going on in the market or we're visiting companies or something like that, we may miss one. But on our Twitter feed, we probably get 95% of the dividend increases are listed there. And so, and of course, you can go and look back at old tweets as well, as if you want to sort of see what you missed over the past couple of months. And Avron, I don't know if you have a better source of information.
No, or is actually, it's that's one of the challenging things for investors is Canadian investors especially is trying to get this information because you have to surf a lot of websites. And sorry, Peter, but 3K is a little steep for me for the monthly. But you know. No, basically, when I look at dividend increases, I just do it the old-fashioned way. I actually go to the companies. I just look at online, look at their dividends, and I just actually look year by year and see what the increases are. TMX money from the TSX isn't bad either, but for Canadians, it's pretty difficult to find all that information in one place. So that might be something you want to kind of consider there, Pete.
Yeah, certainly. There's Canada Newswire has a pretty good website, and they list every press release that all companies sort of publish in Canada. The problem with that is you have to search through everything. So everything from a new head office to a new executive being hired, and there's hundreds and hundreds of press releases, and maybe only 1 or 2 of them are relating to dividends. But yeah, the information is there if you want to spend the time.
And honestly, if I just buy the big blue chips that I feel are as reasonable as they can be and just ignore all those things, then I'm pretty happy, actually.
Or you could just wait until your dividend check increases, and then you know that they've raised their dividend.
Well, that's kind of usually what happens, right?
Casey has let us know that he goes directly to the companies that he holds. And then the registers for their email blasts. So certainly that's a great suggestion to get direct notice from the company whenever there's a specific news item. So yeah, absolutely, exactly. If you're paying attention and you're getting the direct information, you'll be ahead of the game, and it'll be free and it'll be direct. So you won't have to go through any middlemen there.
Great. So shall we go ahead? Are we ready to go live here?
Yeah, it's 1 o'clock, so let's do it.
Okay, so first off, hello everyone, and thank you for joining us. So my name is Avrom, aka the Dividend Ninja. This is my first webinar, and I guess even at my age, there is a first time for everything. So I'd like to thank Peter Hodson for organizing this and bringing this whole webinar to everyone. So we have, like Peter said, we have 900 to 1,000 people who have signed up. So right now, we probably have about 300 to 400 people live. So Peter Hodson, as you know, everyone knows here, he's the editor for Canadian Moneysaver. He's the CEO of 5i Research, and he has quite an impressive background. He was the chairman of Sprott Asset Management, and he was also a mutual fund manager specializing in small caps. So what I'd like to do is I'd like to turn it over to Peter, and Peter, maybe you can let those people who don't know about Canadian Moneysaver and 5i and let them know what the whole thing is about.
Sure, absolutely, thank you. So Canadian Moneysaver is an independent financial magazine that was started publishing in a little town called Bath, Ontario, near Kingston in 1981. It started out with 8 pages, and the whole idea was to try and empower investors and teach them about the industry, how to make money, how to save money, how to reduce fees, etc. So it's expanded since then to 44 pages. It's published 9 times a year. It's fully independent. There's no association with any financial company or bank or anything like that. It doesn't advertise. A lot of the financial magazines, of course, you'll see ads for brokers and mutual funds, and we just don't do that. So we have about 85 writers. Avrom is one of them, and he has nothing to sell except for to educate you about dividends and investments. And so he's one of our favorite authors because some of the authors are in the industry and they're experts in an industry, but they are tied to some other company, but we are in charge of what gets in the magazine, so we only put in what we think is appropriate for investors in terms of the knowledge base that they can grow. So we provide information on taxes, stocks, retirement, insurance, annuities, you name it, we cover it. It's not glossy, it's not fancy, but people seem to like it, so it's been around for 32 years. I bought the magazine under 5i Research in 2011. I had no idea how to publish a magazine for the first year, but things are getting a little bit better right now, thanks to Lana for sure has been helping me out on that side. 5i Research I started in 2011 as well, and it was part of my disillusionment with the investment industry. The investment industry is great. It's an absolutely great place to be if you work in it. The fees are high. You get to go on TV. You get good hockey tickets. You get paid a lot of money. It's just a great industry, but it's not a great industry for investors. The investment industry wants your money. They want to charge you commissions. They want to earn fees. They want to confuse you. They want you to trade, and they basically want to control your destiny. And after 28 years in the business, it just kind of got to me. I saw a lot of things I didn't like. I saw a lot of greedy people. I saw a lot of investors do the wrong things, and I just kind of wanted out of the situation. So I love the stock market, so I created 5i Research to do research, but without all the problems of the industry. So it's completely conflict-free. We have no association with anybody. We don't manage money. We don't run a fund. We don't get commissions. We don't pay investment bankers. We just tell you how we feel, and if you believe that, that's fine. If not, it's fine too. We don't make any money off anything you do other than our membership fees. So we've been around for a couple of years. So far, so good. We've had some good success. We're having fun, and we like to help investors out. We've answered 17,400 investment questions as of today, and because we have no conflicts, we can answer those pretty quickly where we don't have to go to our compliance department and check with our lawyer and make sure we're saying the right thing, because we have nothing to sell except opinions, and we just tell you how we feel. And we don't like a stock, we'll say, you know, it's a piece of garbage, stay away from it. We may be right, we may be wrong, but at least you know our view, and there's no attachment to that view. So
yeah, and that's why I enjoy writing independently as well. I don't have to worry about the content I write as long as I'm accurate and well researched. Nobody's looking over my shoulders, so it's a good deal.
Absolutely. When I was at Sprott, I had to make sure I never said anything bad about gold, you know, just in case.
Yeah. So Peter, I know it's a little early, but how much does it cost somebody to get into 5i Research and get all this information?
We're a little bit like Costco. It's $119 for a membership, and then that gets you everything. Unlike Costco, where you have to spend some more money once you get there. So it's just a membership subscription for a one-year fee.
Okay, I think that's a pretty good deal for the information. Absolutely. So we'll move on to into one of our main topics, and onto the 5-year bull run.
Now, I guess the one question that we get a lot from investors is, the market's been so strong for so long. It's more than doubled since the low of 2009, and there's a lot of fear still that is carried over from the financial crisis. And so a lot of people are basically worried about another problem, another concern, and wondering what they should do now. Should they sell? Should they go to cash? Should they sell in May and go away? Any thoughts on that?
Oh, absolutely, and I've actually been writing a lot about it, and one of my staff writers, actually, he is a pension fund manager, and he was actually looking, are we in a bubble? And I think in terms of the valuations, we're not necessarily in a bubble. But I think it would be unrealistic not to look at the market and realize that not only are we at 5-year highs, we're actually at our record highs now. So, you know, I personally have no idea what the stock market is going to do. I don't think any of us do. And basically, my whole view of the stock market right now is not to be reacting on fear. I think that if you have a solid strategy and a solid plan, you don't need to react to these events in the business news. And in fact, that's one of the best things you can do right now, is simply switch off the business news, because it really feeds on this hype. So I actually know people, and I've met a couple of these people who actually sold their stocks in the fall of 2008 around September, and I think they were very lucky people. And one of those people, he had said to me, he was really nervous about pushing the sell button on everything. He didn't know if he was making the right move or not. He was very lucky, and the other person was very lucky as well. I basically think that selling everything and panicking is one of the worst options that you can do as an investor, because if we look back to, you know, the previous summer, you know, it seems like every August, you know, May to August, markets have been very, you know, markets have hit highs since 2009. And if you sell everything, you would have missed out on the 20 to 30% year-on-year returns just by holding your stocks. So I really think buy and hold is the best approach, and stay with the course. And it's not to say that the market's not going to blow off steam. We could well be dealing with a market correction next month, or it could be next year. Nobody in this here knows that. You know, there's very few people that even have their finger on that. So I basically just encourage people to buy and hold and stay the course. Having said that, I think that for index investors, this is a fabulous time to rebalance, because, you know, your equities are simply going to be you know, you're increasing 5 to 10%, you know, every quarter maybe. So I think it's a good time for index investors to rebalance. And if you are somebody who's holding bonds and you are holding some fixed income, I would encourage you not to sell it. I really remember back from 2006 to 2008, a lot of investors were really negative on bonds, and markets were just going up in a straight line for several years, much like they are now. And a lot of investors, especially in their mid-50s, were, you know, selling their fixed income, selling their bond mutual funds, and you know, piling into all these sort of specialized equity mutual funds. And we all know how that ended for them in 2008, when their portfolios crashed 40 to 50%. So my encouragement is to stay the course, don't sell. And the other thing that you have to consider is, if you sell your stocks, you know, especially if you're retired or you're approaching that retirement, where are you going to draw your income from? Because right now, cash virtually pays you nothing. So if you're holding cash, you know, how are you going to make a monthly income? And as well, I just think that trying to time entry and exit points, you're going to be incurring some fees, and I just don't think anybody can really time the market that well. So
I would totally agree with that. And just, we have a blog on our website about selling in May and going away, so I won't go into that too much. But in every single market cycle, I've seen, I'm getting old now, so I've seen 5 or 6 kind of crash scenarios. I was in the business in 1987 when we went down 22% in a day. I was involved in the flash crash, a bunch of other crashes, the dot-com crash, and in every single case, you had a group of very sophisticated, smart investors telling you to get out, but on the other hand, every single trade took the opposite viewpoint, and that's one thing you have to remember. Every single time there's a trade, there's someone with the opposing viewpoint, and a lot of those people were very smart as well. Some were right, some were wrong, depending on their time frame, but if you go past over the past 50 type of market events that were sort of panic-inducing, they all of course, were buy opportunities for someone with the right time frame and the right mentality. So diversification will win in the end. 2008 was unusual because everything went down except for gold and U.S. Treasuries. But in most scenarios, on average, diversification is your best friend.
Yeah, and actually, in late in 2009, my Canadian bond funds, they were giving me a 5% return, annually, whereas my equities had obviously declined quite a bit, and that's when I started investing in dividend stocks. But by having the diversified portfolio, I certainly had a cushion, and my portfolio certainly declined a lot less than a lot of other people who are into the specialized equity funds.
And of course, this is where dividends come in. If your dividend stocks are secure, and if your company is making money or at least making cash flow, and you do not need to sell, you don't need the capital, then just keep collecting the dividends. If your company is good, solid, and has been around for a while, it's still going to be here when the crisis is over. You're still going to get that dividend check, and you won't have to panic and sell out at the wrong time.
Yeah, and actually, oddly enough, your yield actually, although it's the same on share, your yield actually increases in a declining market anyway. So, this is just a fabulous time, I think, not to hold too much cash, but certainly when those market declines happen and the stocks go down, I really think the buy and hold and topping on the dips is the way to go. No doubt about it in my books.
I agree. Okay, next slide, I think.
Oh, this is my slide. So, speaking about dividend stocks, because that's what we're talking about today. So, I just want to discuss some of the things I look for when I buy a stock, and then Peter will probably have even more to say on this topic. Basically, when I'm looking for dividend stocks, okay, I'm very conservative. I don't like to take a lot of risk. I want to, especially as I'm older and getting closer to retirement, I basically want something solid, stable, and secure as possible. So when I'm looking at the dividend stocks, one of the key, easiest things I look at is the dividend yield. So for me, I'm looking at a dividend stock with a range of maybe 2.5% to 5%. Except for REITs and some of the previous income trusts and these kinds of companies, they're going to have yields obviously up to 5 to upwards to 8%, simply because they are paying the full dividend without a corporate tax. However, generally when I'm looking at the big blue chips, if the yield starts to go over 5%, in a stable market as we have, that's a red flag to me that why is the dividend so high? Conversely, I'm not a fan of low yield stocks, and stocks that come to mind that are generally lower yield tend to be in the resource sector. So we'll be looking at gold producers like Goldcorp and Barrick. They generally have the low yields. Ironically, they're dividend growth companies, regardless of Barrick's problem over the last few years. Goldcorp and Barrick, they tend to actually increase their dividend on an annual basis. However, for me, I'm after the monthly income. So dividend yield is the first place I look. I'm looking for that 2.5% to 5% range, unless, like I said, I'm looking at some of the income trusts or REITs, which tend to have a higher yield. When I'm looking at dividend stocks, one of the second things I want to look at is what's called the dividend payout ratio. And I've got quite a few articles on my site about this. It's just basically the annual dividend divided by the earnings per share. Very simple ratio. The dividend payout ratio for a big company, established blue chip, is really important. It tells me whether, not only if the dividend is sustainable, it also tells me if there's room to grow the dividend. So for example, I believe a year ago, Johnson & Johnson is a big example. Its payout ratio is starting to get over 70%. Likewise, I have personally not invested in BCE, even though it's a great telecom company, simply because I've always felt that its dividend payout ratio is a lot higher than TELUS or Rogers, as an example. So if you're looking at a big stable blue chip, and you start to see like the dividend payout ratio getting up to 70, 75%. Again, this is a red flag, and it's usually tied into other things like declining sales, change in economics in a sector. So secondary I generally look at is the dividend payout ratio. There's one important point I wanted to make here about the dividend payout ratio. Generally, if you're looking at income trusts, say junior and oil gas companies, REITs, real estate investment trusts, the dividend payout ratio is not going to tell you very much because you're going to end up with a very high ratio, you know, nearly 100%. And the reason is because these companies are using cash flow, some form of distributable cash flow to measure their payout ratio. So again, if you're looking at the dividend payout ratio for these kinds of companies, don't use earnings per share. You actually have to look at the cash flow. And that's something that I will actually get Peter to discuss a little more because he has the small cap background and he can talk about that a little more. One of the third areas I want to look at in a dividend stock is not only the dividend yield and the dividend payout ratio. I want to know that I'm actually investing in a profitable company. So one of the easiest ways to determine this is to go to Yahoo Finance, go under key statistics, and look for the profit margin. In this case, it's a net profit margin, and this tells me how profitable the company is. So let me give you a quick example of a stock I bought that was a mistake. I bought Staples, I believe, about 2 years ago. It looked like a great company. It was the dominant player in the office industry. It sold a lot of tech and computers. It was a dividend growth company, raising its dividend, you know, almost every year, had low debt, great management. But the one problem with Staples was the profit margin. It only had a razor-thin profit margin of 2%. So what I learned the hard way was when you invest in a company with a very low profit margin, you know, where's the room for growth? And sure enough, you know, every quarter Staples would miss estimates, and its share price has been quite volatile as its sales have also been declining. So as well as the profit margin, another area I want to look at is how much debt a company carries. And, you know, utilities are generally going to carry much more debt, as with oil companies, because of their capital expenditures. I mean, pipelines as well. They can't simply pay cash to go build a pipeline, right? It's like a homeowner, they need to go get a mortgage to pay for their house. So some sectors generally have much more debt. However, so if you're going to look at utilities, you're going to look at pipelines, like look at the whole sector, see what the you know, the average debt to equity ratio is in that sector. But having said that, companies that have low debt tend to prosper. They tend to do well. They tend to raise their dividends, and something that Peter will talk about too is they tend to do well in a recessionary or change in economic cycles. Companies that have high debt, I mean, a lot of the previous income trusts come under this category, and some of the, even the big blue chips too. Companies that carry high debt generally tend to get themselves in trouble. So you can be sure that if a company gets into trouble, the first area that a company will have to look at is the dividend. It'll either have to cut or not be able to sustain it. So look for company debt, and again, look for the profit margin. So for company debt, the debt to equity ratio is a broad measure. It's where I look. I like to see something, you know, 30% or lower. It may not be realistic in all sectors, especially utilities, but it's generally one of my starting points. And lastly, look for dividend growth companies. So again, you know, the whole point of dividend investing is for monthly income, and one of the big bonuses of the whole dividend growth model is that you get these dividend increases over time. It helps to keep pace with inflation, and it shows that, you know, as the share prices of these companies increase, because they increase the yield, it keeps your investment in track. And again, you know, for me, I find that when I want to look at dividend growth, as I stated at the beginning of the seminar, one of the easiest ways to go do this is just to go look at the company directly. Look in the dividend tab, and you can see the dividends that these companies pay out every year. And you can look and just calculate the percentage, see what the dividend increase is. There's a lot of bloggers out there who also track dividend increases, but unless you're subscribing, it's pretty difficult to find these all in one area. So Peter, did you want to talk about the drips added when companies are short of cash and the whole dividend performance in recessions?
Yeah, absolutely. And actually, if I could touch on some of these points as well, because I'm going to add a couple of comments. If I could go through, because obviously what to look for before buying is probably the most important part of dividend investing. So first off, on the dividend yields, I totally agree with you that a high yield generally implies high risk. But I would put the caveat there that if the whole market is down, then you may have to look at high yield dividend stocks a little bit differently. So for example, in 2008,
Oops, looks like Peter faded out there, so hopefully we'll get him back. Yeah, so like Peter was saying, when you have a market where all stocks are down, you want to look at these sectors in relative terms, right? Not just individually. So, I mean, a classic example was during 2009. I mean, the Bank of Montreal, companies like this had maybe a 12% yield, but it was for a very short period of time.
Avram, would you like to move on to the mutual fund slides, and then we can double back on these?
Yeah, I think that's a good idea, and then Peter can come back and talk about his dividends.
Yep, there we go. Okay, so we're on killing investor returns year after year.
Yeah, thank you. So these slides are actually from my UBC presentation last year. So those of you who are out at UBC would have noticed these slides, and I talked about the mutual fund industry. So one of the whole things with, and Peter can get into this topic because he has plenty to say on it, is that when I'm at work and I talk to my coworkers and I tell them I'm buying stocks, they think I'm nuts, like they think I'm trading and whatever. They have no idea that the mutual funds that they're buying, are really actually negating all their returns year after year. So it's the main reason why I basically sold all my mutual funds in 2009 and moved to a discount broker and started buying stocks for myself. So, I mean, to give you an example, if I buy 100 shares of the Royal Bank, just as a quick example, my trade fee with TD Waterhouse is $9.99. If I'm basically going to Quest Trade, it's half of that. And this is the only fee I ever pay for owning this stock. When I buy mutual funds from a mutual fund dealer or broker, basically I'm paying a lot more than that $9.99. So first off, a lot of mutual funds basically have front-end loads, right? So if you want to buy, say, a Trimark equity fund or whatever mutual fund, you are essentially paying maybe 4% up front simply to own that mutual fund. Now, when 3 or 4% doesn't sound like a lot, but you have to earn that 3 or 4% back to even break even. I think one of the worst mutual fund fees are the back-end load fees. So basically, your mutual fund, if you decide to switch or sell within the period of time, say 0 to 5 years, your mutual fund's going to turn around and charge you a fee when you sell. So, that one's really bad because you have basically held this investment, you've made year-on-year returns, and you are actually paying a commission on a higher amount than you started with. And then there's deferred sales charges, which most people know. If you sell your mutual fund within, say, a year, sometimes it's as high as 6%, and then it goes down to about 3%. But regardless, so these front-end fees, there's absolutely no reason for investors to be buying mutual funds with these fees. What most people don't know, and I'm surprised, I talk to people at work or my friends in business and whatever, they have absolutely no idea that their mutual fund is actually charging them an annual and ongoing fee. And Generally, the equity funds tend to have a much higher management expense ratio, is what it's called. So every year, let's take an example, say the TD Canadian Dividend Fund, which generally has around, say, 2%. This is what the the largest mutual funds in Canada generally charge around for their management expense ratios. Every year, you are paying 2% ongoing fee. Welcome back, Peter. So I moved on to mutual.
Okay.
I moved on to mutual fund fees, but did you want to cut back and talk about the stocks again?
Yeah. Why don't you finish off, and then we'll back up again.
Okay, great. So I was just talking about the whole front-end load fees, back-end loads, deferred sales charges, and these hurdles that investors have to get over just to even break even when they're buying mutual funds. So let's move on to that next slide, the Andrew Hallam slide. What's really remarkable is that actually in the entire world of all the G7 nations, Canadians are actually paying the highest mutual fund fees, and they have been for a long time. We are actually paying double what Americans are paying for their mutual funds. When I talk to my fellow US bloggers, they say, well, why are you so down on mutual funds? And when I tell them the percentage of the management expense ratio they're paying and the commissions that we pay up front and deferred and the backload commissions, they go, wow. And Andrew Hallam had a fantastic book about 3 years ago called Millionaire Teacher, and he actually did the research and broke it down. He found that the average Canadian for holding their mutual fund is paying 3% per year in ongoing fees. So this includes the management expense ratio plus the load fees. And actually, I think 3% is pretty conservative. When you start counting in the loads with the 2 to 2.5% annual MER, I think that percentage is much higher. So out of 18 countries, Canadians are paying the highest mutual fund fees in the world. So every year, you have to overcome this 3% just literally to break even.
And this is usually the point in a webinar that myself, as a former mutual fund manager, I have to apologize to every investor in Canada because we had some very, very high fees that we were charging investors. And I like to use the analogy of a hockey player. If you have a son and your son is a slightly better than average hockey player, would you advise them to quit school because the NHL is going to call and they're going to make $5 million a year as a slightly above average hockey player? You wouldn't do that. That would be crazy. But if you're a slightly above average mutual fund manager, you get paid a ridiculous amount of money and you're just a superstar just for being slightly above average. And that's because, of course, only about 1 or 2% of mutual fund managers can actually beat the fee over the long term in terms of the market index. So it's just ridiculous. So I'd like to apologize to everyone that paid high fees when I was a mutual fund manager. As I said at the start, it's a good business to work in, but it's not a good business for investors. So.
Yeah, and actually, as a mutual fund manager, right now, you'd actually have to be buying stocks at a higher price just because you'd have more inflow of money as well, right?
It's a pretty interesting scenario because what happens is it's almost worst case scenario because when you have a good year and the market is going up, the money pours in. We had one company, I worked at a couple of companies, I won't tell you which one was which, but we had one company where we were getting $5 or $6 million per day and the market kept going up. And so we as managers, we're supposed to be the professionals, we're supposed to be running this money. We could not hold a lot of cash because it's pretty hard to justify a 3% fee just to hold cash. So $5 or $6 million a day is coming in. The market's going straight up. What do we have to do? We have to buy. So it's a self-fulfilling prophecy that we're buying on the way up. Then, of course, it reverses. The market's crashing. What does everyone do? They take out their money. So suddenly you're sitting with 1 million shares of something and you have to come up with $1 million to fund a redemption. So guess what? You're now selling at the exact wrong time. So not only does that fee tick in, day out, you're buying at the top and you're selling at the bottom just by default the way the fund flow goes. So it's a pretty bad industry the way it's set up. And I also like to throw in when we're talking about being a manager is say as a manager, I didn't really like the market. I thought it was overpriced and overvalued, and I was sitting on 50% cash. Well, I'm charging 3% management fee for that 50% cash, and my boss comes in and asks me, what am I doing? And I say, nothing. How's that going to go over? Or when I meet investors and they say, what are you doing? I go, nothing. How's that going to go over when they're charging, when they're paying 3%? It just doesn't work that way.
Yeah, good point. And not only that, going to the Rob Carrick slide next, he covered this in depth actually. The average Canadian equity mutual fund, so get this, the average Canadian equity mutual fund has an annual management expense ratio of 2.4%. So actually, Peter, a lot of the small cap funds that you were managing, they would have even had a higher MER probably, right? Like in the 3+%.
Yeah, and again, you're embarrassing me because there were some that were 2.9, 3%. And then on some of the funds I ran, they had a performance fee as well. And so in 2007, for example, I had a really, really good year. And so we had all sorts of performance incentives kick in. And my MER that year on my fund was over 5%.
Wow.
Investors were happy because it was a good year, but they weren't that happy in 2008 when things reversed pretty quickly.
And they were still paying the fee. So
that's right.
Talking about these so I mean, naturally, there's been so much research on this, but just because you're basically having to buy your, as a fund manager, you're having to essentially buy high and sell low. You're already below the market performance to begin with. I guess that's the inevitable. But so, when I did my presentation at UBC last year, one of the things I looked at is okay, so what are Canadian mutual funds buying? And is it worth the 2% to 2.5% that you're paying for these funds? And that leads into my next slide, which is essentially to buy what the mutual funds buy. So we can look at this one here. What I did is I'll just give you a quick nutshell for those who weren't there at the seminar. I basically looked at the top 10 Canadian. In this slide, the top 10 largest Canadian dividend funds, and I basically looked at their top 10 holdings. The reason I looked at the top 10 holdings was because those holdings account anywhere from 40 to 60% of what the mutual fund owns. So these top 10 holdings literally account for the majority of the performance in that fund. And if you start to look at these stocks that these funds own, what you quickly see is, obviously this is the Canadian dividend category, but what you quickly see is all the large banks and resource companies and perhaps even the telecom. And this is pretty common. So have a look at these the columns on the right, numbered 1 to 10, which correspond to the mutual funds, and you can see that the Bank of Nova Scotia is actually in the top 10 holdings of 9 out of 10 funds, right? You have Enbridge, again, which is owned by 9 out of 10 of these funds, and there's no diversity here. If you go to your mutual fund and dealer and you say, hey, I've got all my holdings in this one equity fund, and he says, well, then why don't you, instead of just Trimark, why don't you go over and buy a Beetle Goodman equity fund? And well, it doesn't really matter because you're not getting any diversification. You're essentially holding all the same thing. But here's the thing that gets interesting. So these dividend yields are actually a year old, so the dividend yields might be a little lower today. But if I take the dividend yield of all these holdings, top 10 holdings, I'm around 3%. So this is the yield that these funds are generally providing, plus or minus. If I was to buy these stocks directly in my dividend portfolio, which I do, and many of you listening as well, that's what you do. If I was to actually buy these funds directly, this is roughly the yield that I'd be getting for owning all these stocks. And not only that, there's no management expense ratio year after year after year, no fees, no commissions. It cost me $9 or $4 to buy the stock, and that's it. Now, when a mutual fund calls itself a dividend fund, and it's giving you a 3% yield, but it's taking off the MER of 2%, it's pretty easy to see that it's not really a dividend fund. You're getting maybe 0.5% to 1.5% income per year. So the MER really siphons off the amount of dividend income that you're getting. And the next slide actually, which is not just dividend funds, but all of Canadian equity funds, you can see the same scenario. In this case, again, it's all the big banks, energy companies, telecoms, and usually you'll find Barrick Gold and Goldcorp in there as well. Collectively, you're getting around the 2.83% yield by holding these stocks directly, but if you held them in a mutual fund, less than 2%, you'd be getting a lot less. So, Peter, anything you want to say on that?
Yeah, I mean, this could be a whole seminar as well, but a couple of things. As a mutual fund manager, we watched what other companies held in their funds very, very closely. So if we're running one type of fund, we needed to know what the competition was owning, because of course if they own something that we did not, then we're taking a bet against them, or we need to know why they own that particular stock. So not only do the managers kind of follow everything, it just more leads to more of the same when they're all watching the same sort of investment. Yeah. A couple other points. One is if you set up the right portfolio, most companies, some of the larger cap companies, they pay their dividends on a quarterly cycle, whether it's March, June, September, December, or a different cycle. You can set up, if you're careful and look at when they're paid out, you can set up a portfolio so you'll get actually dividends every single month, and you can turn your own fund into a monthly income fund as well. So that's one thing to pay attention to. And then, go ahead.
Oh, no, I was just going to say one of the posts that did the best on the Dividend Ninja, it only took me 20 minutes to write, as I said, just space out your dividend stocks by the month that they get paid, so you can get a continuous, because I mean really, if you're going to be buying a bank stock or a telecom and they're all, I mean usually they pay the same month, but you can actually space your dividends out and actually get your monthly income spaced out rather. It's actually quite a good, effective strategy.
Yeah, absolutely, and especially if you're reinvesting those dividends back into the market. If you're reinvesting every month instead of every 3 months, then of course you're going to get the benefit of the time value of that money as well, with more compounding as you invest on a regular basis. The other point I'd like to make out is if you're looking at other mutual funds and you want to replicate a portfolio, you can often keep out the companies you don't want, where of course if you have a mutual fund, you have no say in the matter. They're just going to own whatever they want to own. But say you don't like Goldcorp, or say you don't like Barrick, which has been a horrible investment for the past 10 years, you don't have to buy it. You can high grade a mutual fund portfolio, and you can get better performance with lower fees, but also a better portfolio tied specifically to your needs. So it's a great strategy.
Yeah, and that actually kind of leads into your slide about how to build your own mutual fund, where you talk about own the 10 sectors of the TSX. There it is, that point right there. I actually just wanted to bring up before you get started, Peter, I just wanted to bring up a Rob Carrick article from November last year. It's quite an epic article. He talked about the 2-minute portfolio. And what he basically said was to just buy the 2 largest companies in each of the 10 sectors of the TSX. So you'd actually end up with the top 20 Canadian companies. And it was actually quite an interesting portfolio, because you actually ended up buying companies like Barrick and Goldcorp. But what was interesting was it actually like David Stanley's beat the TSX, it actually outperformed the TSX and beat it almost every year. It was actually not only that, it was actually less volatile. So it was a very stable portfolio. So leading to your point there, just don't load up like mutual funds do in 3 or 4 sectors. Spread out your stocks amongst the 10 sectors. So go ahead, Peter.
Absolutely. Yeah. So if you want to replicate or build your own mutual fund, there are 10 sectors on the TSX. Take a look at those. Decide what your risk-return scenario is and how much risk you want to take. If you're conservative, then you can own more financials, telecoms, and utilities. Those are sort of the safer names in the group. If you're more aggressive, you can go for industrials or infotech or resources or energy. You have to decide your various sector allocations. That's the first step. You also have to decide how much you want to own in international stocks. We suggest you buy ETFs for those. Again, it's fairly hard to duplicate an international portfolio. You can do it in the U.S. with some stocks. If you really want to pay attention to a bunch of stocks, that's fine. But in the U.S., of course, ETF fees are very, very low, and you can get a very, very well-diversified ETF and pay 0.1% as a management fee. So it's quite attractive in terms of fees and diversifications. If you're, again, if you're duplicating an index or a mutual fund, own the large caps, because that's what the indices and the mutual funds, that's what they own primarily. So you want to get the same performance without the fees, which will translate into better performance. So own mostly large caps. You can add some small cap exposure for growth. This is where the action is. You have to do a little bit more homework, but there's some great small cap companies in Canada, and you can overlay those with the large caps, and you'll do particularly well. You'll boost your return, and you'll also increase your diversification. Talked about this a minute ago. High grade your companies. Just because a stock is in an index does not mean it's good. The index in Canada is designed, anything goes in the index. If it's liquid, large, if it trades a lot, it goes in the index. It doesn't really matter if it's a good or bad company. We all know that Nortel was in the index, and look at how that worked out. We all know that Bre-X was in the index, and look at how that worked out. I can't actually tell you if Sino-Forest was in the index. I can't even remember, but not all companies in the index are good. If you don't like a company, don't buy it. Again, unlike a mutual fund, you're in control here, not the manager. If you focus on companies that pay dividends and have low debt, you don't really have to worry that much over the long term. Through the cycle, you should be fine. And we like to focus on companies that don't issue shares. If a company doesn't issue shares, generally it means it doesn't need cash. And generally, if a company doesn't need cash, it generally is a pretty good investment because it's generating its own destiny and it's not dependent on other investors to fund its growth. Going forward, a lot of people focus on, we'll go to the next slide, Lana. A lot of people focus on the stocks that are down. If you have a portfolio of 20 to 25 stocks, look at it from a portfolio point of view. You are going to have a couple of stocks that aren't going to work out. If you have everything working out, then good for you. You should probably, might be running a mutual fund for someone else. But it won't work out that way. You'll have a few losers, but focus on the portfolio returns. Your winners should far outperform your losers. Over a period of time, you might even have a stock that goes down 40, 50% if you pick the wrong one. But over a period of time, you should have a couple of stocks that double or even triple. We started following a company called Auto Canada 2 years ago. It's gone from $6 to $71 in 2 years. So that's where you want a little bit of small cap exposure. Keep your losses at a minimum, and the big winners will rule your portfolio. So get rid of the losers. Sorry?
No, you were just going to bring up exactly my next point, and that is that people want to sell their winners and keep their losers, hoping they turn around. And actually, it's really the other way around. So you should really be keeping the winners.
We've had so many questions about, investors have asked us questions, and they say, I will sell that stock when it gets back to what I paid for it. And we just kind of shake our head. Breaking even is not an investment strategy in our viewpoint. Getting your money back is not a good strategy. So when you have a real company that is underperforming fundamentally, now this is where it gets important. Do not sell it just because it's down. Sometimes stocks will go down. Sometimes a big seller needs to sell. Sometimes a company will, have a bit of a problem. But if the fundamentals are changing, if the growth rate is changing, if the debt is increasing, then it's time to get rid of that weed and put that money to work elsewhere with a better company. But don't sell just because it's down. Do the fundamental research and decide whether there's a situation that's changed. Same thing on the upside. One of the worst things you can do is sell because a stock is up. And we see that time and time again. People sell because it's up. We just think that's a horrible reason to sell. You have to find out why it's up and what's going on and why someone else is buying that company at a higher price than what you paid. Monitor your sectors. If you had that asset allocation, sector allocation at the start of this exercise, you don't want to let it get out of hand. If the oil and gas sector is doing very, very well, and you originally wanted a 15% weighting in your oil and gas stocks and it's moved up to 25, it's time to rebalance. There's no problem in selling there for a portfolio reason. Just simply get back to a diversified portfolio, because the oil and gas sector will probably turn around one day, and you don't know when that's going to happen, and I don't know when that's going to happen, but when you have diversification and rebalance your sectors, you should be fine.
Yeah.
Ignore recommendations. I could put a whole seminar on about how analysts try and get you to sell and get you to trade and get you to generate commissions. Just ignore them. Focus on your own stocks and your own sector allocation, and you should be fine. Don't hold too much cash. A lot of people think they need to hold cash. This is one of those situations where it's a personal decision. If you have more money coming in each month than going out, you don't really need any cash. If you have other investments, rental properties, things like that, then you don't need to hold cash in an account, and you'll maximize your return over the long term, of course. Again, it's all up to you personally about how much money you might need and how much money you have coming in. But a lot of asset allocation models automatically own 10 or 15% cash, and we just think that's not appropriate from an average point of view. It depends on the individual.
I think
focus on.
I think staying fully invested is the way to go. Whether you're indexing, holding bonds and equities, or you're holding a 100% dividend portfolio, whatever your model is, stay fully invested. Holding faith, but you're outside. So, just wanted to make that point.
Absolutely, and of course, if you're owning the right types of stocks, if you're owning blue chip stocks, you can get your money out if you need cash for a commission of $9, and the money's yours in 3 days. So,
or you just
it's one thing I
switch your
stress that
drips
as well
off,
as that.
Just switch off your drips, and then you can accumulate your cash that way as well. That's another way to do it. So, generally, what I think too is, we brought this up, is that if you stick with the dividend growth companies, I mean, there's some fabulous bloggers in Canada and the U.S. who simply they will only buy a dividend growth company, so they will actually trim out, I wouldn't, but they will actually trim out companies that don't actually raise their dividends for a year or so, because they believe that's a warning sign that there's other problems emerging with that company. So again, focusing on the companies that have the 5-year, 10-year dividend growth, generally you're going to be avoiding, well, you're not going to avoid losers, but you're generally going to be investing in more stable and reliable companies. And, as Peter said, don't worry about the market swings. You're going to get stocks that are down in your portfolio. You're going to get stocks that are up. For me, what I'm really concerned about is the monthly cash flow. So I don't really, to be honest, I really don't care if, or being opposed to being dishonest, I don't care if McDonald's is $50 a share. I don't care if McDonald's is $100 a share. If it continues to reward me with that nice 3% yield and increase it, and it has increasing sales, then I'm perfectly happy holding it.
Okay, so we should open it up to questions, but if I could go back to the slide that I got cut out on, that would be great.
Yeah, that'd be great.
I don't know what happened, but I'm back. But all I remember is saying that this is the most important part, and then it all went dead. So.
Well, you jammed out, right?
Yeah. On the dividend yield, it is a warning sign if the dividend yield's too high. But as I was saying before we cut out, if the whole market is going down, you have to look at that yield a little bit differently. If everything is being sold down, then maybe that dividend yield is actually an opportunity and not a risk. And I like to highlight Tim Hortons here. When the European economy was rolling over and it looked like the Euro region was going to break up, the yield on Tim Hortons went up because the stock went down. And for the life of me, I couldn't figure out how a crisis in Europe was going to affect, someone going through the drive-thru having to double-double. It just didn't make any sense. So take a look at what's going on in the world. One thing on the payout ratio, you do need to look at some of the fundamentals as well. If you have a high payout ratio on a company, generally that is a warning sign. But if a company has a lot of cash, maybe they have no debt and they're sitting on a lot of cash, then certainly they can pay a dividend for a long period of time without any problems. So you do have to sort of look beyond the basic ratio. There are companies that add dividend reinvestment plans to save money. When they're issuing shares instead of dividends, it actually gets them a bit more cash that they don't have to spend or they don't have to give out to shareholders. So when you see a DRIP, generally we think DRIPs are one of the greatest things ever invented, but you can't just buy them willy-nilly. Sometimes companies try and play games and try and save cash by putting in drip programs with big discounts because they really have no other way of funding cash and they don't want to cut their dividends, so they try and convince shareholders to get shares instead of cash. So one thing to watch out for. Back to the ratio as well. If a company is in a cyclical business, then obviously a high ratio is more risky. If a company is depending on commodity prices to meet their payout, then commodity prices decline, then you're going to have a problem. So a company that has no ties to commodity prices and doesn't have a cyclical business, they could have a 75% dividend payout ratio and not be a problem. A cyclical company could have a 50% dividend ratio, and you could be in a problem scenario very quickly if conditions change. So you do have to consider the sector.
Yeah, you have to
consider the sector.
Absolutely.
Sorry, we're cutting in and out again a bit. Do look at cash flow in addition to earnings. Certain companies, if they have accounting charges or special charges, then sometimes their dividend payout ratio may look quite high, but when you look at the company in terms of cash flow, it's not so bad. And then I like to look at how a company did during a recession. If the company survived a recession, and especially because 2008 was not that long ago, if they survived that period of time with a decent payout ratio, kept paying their dividend, then you're probably going to be okay in the next down cycle and the next mild recession, assuming it's not any worse, which we hope it won't be. But companies in 2008, 2009, I could give you a list of 15 to 20 companies that actually raised their dividend in the middle of a financial crisis. And those are the names that you want to keep for the long term, because if they can survive that scenario, they're probably going to be okay. And I always throw out the name Home Capital in this example, because Home Capital is in the housing market and they're in the mortgage business. So we had a financial crisis that was brought on because of financial instruments in the mortgage market were falling apart, and here we had a mortgage company that made more money in the recession and paid a higher dividend in the recession than it did in the prior years. It just was a stunning example of a company going the opposite way and actually doing better than what everyone expected. Now, Home Capital, sure, the stock got absolutely clobbered in 2008, but their dividend went up and their earnings went up. So that's a scenario where maybe, I don't know if you sold it or if you bought it, but it's a scenario where the yield was not reflective of the reality because of what was happening in the market. So I'll end that slide. I just want to add 5 points about why dividend stocks are good. And we have a blog on our site, 5iresearch.ca here, if you want to go into it a little bit more detail. But one, dividends instill management discipline. If you have to come up with money to pay your shareholders every 3 months, then you're not going to go out and spend a lot of money on a crazy acquisition, or you're not going to go out and buy a jet for your executives because you need to pay those investors first. If you have to cut the dividend, it's very, very bad for the company. Dividend companies prevent panic selling. If your company is paying you a consistent amount of money and you need cash, which one are you going to keep? The one that pays you money every 3 months or the one that doesn't? In general, you will sell the company that is not paying you income before you sell the company paying a dividend. Number 3, dividend stocks, because of the point number 2, they tend to be less volatile. That dividend always attracts some investors. As the stock declines, you get more investors interested in the dividend, and the stocks tend to be less volatile when they pay a dividend. Number 4, of course, in Canada, is the dividends have a tax advantage with a dividend tax credit. Unlike interest, the government's giving you an incentive to actually buy these stocks. You might as well take advantage of it. And then the 5th point is, it's been proven academically that companies that raise their dividends have been the best investments over the long term. Not companies that pay high dividends, but companies that grow their dividends. You get higher income, and that higher income attracts new investors, and those new investors push up the stock price, and you get an absolute fabulous performance on average from companies that raise their dividends. So we like to look at first initial dividends, because of course if you've never paid a dividend before and you start paying one, then hopefully that dividend can grow and you can kind of get into that sweet spot of a company growing its dividend and getting stellar long-term performance. So we've listed 4 or 5 companies there that have recently started dividends, and that's one of my favorite things to look at, is when there's a new company paying a dividend for the very first time. It's a very significant statement from a company.
Yeah, I was thinking of some big models like that. We had Cisco Systems, CSCO a few years ago, and Apple paying a dividend. I mean, they're both in the tech, but it's interesting that they took all their cash flow and started paying the dividends. So I don't own either, but Cisco Systems actually is kind of actually on my watch list right now, oddly enough. So.
Okay, should we open it up for questions?
I think that's a great idea.
Okay. Okay, Avron, just because of the latency with you and I talking at the same time, why don't we do one each, like
Sure.
alternate? And I'm not sure. Can you see them? Can you see the questions?
Yeah, they're on the little right-hand area there.
Okay. Okay. Well, I will. I'll start off. How about that? As soon as
Yeah, you read the questions out so everybody can hear them,
Okay.
and then.
Okay. So the one I've got is: should I buy dividend stocks or a mutual fund? So I think we've sort of answered that with this presentation. We really don't think mutual funds are necessary. If you do a little bit of work, it's not as difficult as it seems, really. And you can also cheat by following what the mutual funds do. So, as we sort of laid out in a couple of slides there, we would far prefer a diversified portfolio of 15 to 20 stocks than almost any single mutual fund out there in the world.
Yeah, exactly. Couldn't say it any better.
Okay. Oh, just a general question. I can answer this, Avron. Is basically is this seminar going to be posted on one of our sites? And I think the answer is yes on both sites, and we'll probably post it on YouTube as well.
Yeah, I'll actually be creating a page for the recorded webinar as well on the Dividend Ninja and making the PowerPoint presentation available as well.
Okay. And here's a question for you, and I apologize, my questions are kind of bouncing up and down a little bit, so they're hard to follow. But the basic question is, why does the dividend yield increase as stocks are falling? It's just a sort of basic general question, but it's important.
Yeah, well, it's just basically because you're dealing with a ratio. So, I mean, your dividend yield is basically the annual dividend divided by the price per share. So, obviously, if the annual dividend, I mean, if the price per share obviously drops, then the yield will obviously increase just because it's a mathematical ratio. So, and actually, that's one of the things that I'll just bring up real quickly, even though it's question time with high yield stocks. Beware the value trap with high yield stocks. The reason they generally have a high yield is because the share price has been crashing. So.
Okay. Got a question on what are the trading fees for online brokers? Is there a purchase and selling fee? Generally, there's been a lot of price discounting, price competition in the industry, and there are plenty of companies on the online market that can buy and sell for $9.99 or even less now. So. In the old days, commissions were a big impact in terms of performance, but now when you can buy a stock for $9 and never pay a thing again, it's certainly worthwhile to do it yourself. There are some companies, at 5i, we don't recommend companies, so we're not going to say any names, but there's some companies out there that will let you buy ETFs for free. So if you're a buy and hold investor, you can buy them for free and never pay any dime in any commission ever if you're going to hold it forever.
Yeah, and I think the industry in Canada is changing too, where I mean, Questrade has been doing the commission-free ETFs for a while, though I'm not a fan of Questrade personally, but I think it's only a matter of time before TD and the Royal Bank also follow suit. So that's a big bonus for investors. And they've also, yeah, go ahead, Peter.
Oh, no, I was just going to read you the next one, so you can finish off that one.
No, go ahead.
Okay. So can you talk about your thoughts about dividends as a substitute for bonds in a retirement income portfolio?
Yeah, I think that's not a good way to look at dividend stocks. They certainly do not replace bonds, and even preferred shares. Don't look at them as bonds. Dividend stocks, even though they pay you a dividend and pay income, they are not bonds. Stocks are equities. They're still stocks. Bonds are a different asset class entirely, and they tend to, bonds generally react much differently to market events. So, for example, in 2009, when the market was crashing. Bonds held their ground while stocks were plummeting. And right now we're in the opposite scenario where bonds are not performing well at all because of high market gains and low interest rates. But they're different asset classes, and don't confuse the two. You'll get yourself in trouble.
Okay. We've got a lot of sort of specific stock questions online right now. We'll leave those for now. 5i answers stock questions. We have 17,000 questions that have been answered on our archive, so we'll skip those for now. But we do have one question about asking for the list of the companies that raised their dividends in 2008. We actually haven't put that list together yet, but we will. We do plan on putting it out. The question was asked as 50 companies, but the actual number is about 15. 50 was times were pretty tough, but 50 would be a bit too many. But certainly there were plenty of companies that did raise their dividend in 2008, and we'll get going on that list. It's
actually, Peter, why don't you do that as a guest post for me on the Dividend Ninja? I was going to ask you about that earlier. I think that'd be great.
Okay. Well, hard to say no in person, so okay.
There you go. You're accountable now.
Avrom, do you have any comments on? Oh, okay. It says, do ETF managers have to buy when cash comes in and sell when ETF owners sell, similar to mutual fund managers? So basically, it's the question is the mechanics of how the ETFs work. If you want to address that.
Well, you'd have more of an idea, but generally the answer is yes, because they're mandated, again, not to hold cash. So if, say, the manager who owns XIU has a huge cash inflow, yes, he has to put that money to work. So yes, they have to buy buy stocks. Not only that, they also have to rebalance their holdings as well, which is also mandated by the ETFs. So there will always be small commissions and fees and charges in an ETF, and that's why they have the the management expense ratio in an ETF to cover those.
Yeah, and they also, when there's a big order, if there's a sell order, they often have to short stocks to meet that redemption as well. And if your ETF is fairly small, it can cause a bit of problems. Just because there's an ETF on an asset class, it does not mean that asset class itself is highly liquid. And there was a few problems created a couple of years ago where a lot of people were selling ETFs, and it sort of froze up certain asset categories because everyone was trying to sell the same stocks at the same time. So they're not risk-free, and we generally would advise someone to avoid an ETF that was below $50 million in assets just because of that problem.
Mm-hmm.
One question, Avrom, would you suggest selling all bonds?
Absolutely not. These are, this just reminds me again of the 2006 to 2008 when we had stock markets going up in a straight line. So, and human behavior, when we see something go up in a straight line for a long period of time, our assumption is that it will continue to go in a straight line, and in fact that actually never happens. So for those who actually held their bonds during the financial crisis, again, they were getting the 5% per year, 4.5% to 5% return per year when markets were plummeting. So again, regardless of the interest rate cycle, bonds are cheap right now. And you have to look at bonds not only in the interest rate or the yield to maturity. You have to realize that bonds are actually a different asset class to stocks. So they will help hedge you if we run into a difficult market condition. So if you hold bonds or bond funds in your portfolio, and I'm talking about the pretty conservative Canadian bond funds, I would personally keep them. If you are a 100% dividend investor and you're comfortable with the price swings, then don't just stick with your strategy, but don't sell your bonds. That's my personal advice.
Okay, and I would agree. I mean, there is a from an asset allocation diversification point of view, they can still make a lot of sense. When the market declines, you'll be glad you had some. We've had a lot of questions on what to do with a lump sum of cash. So some view the market as overbought, some view it as oversold. If someone's investing right now, the question is really, do you invest it all at once, or do you dollar cost average and invest over a consistent period of time? So if I can address this, we've done a lot of work on this, and there's quite a few academic studies out there, and they all indicate it's better to better to make one lump sum purchase. And if you think about it, that makes sense because the market's gone up over time, and if you put in a lot of money now, you'll get the benefit of that instantly, and you won't have to you'll get compounding working for you. But from a practical point of view, we found it's far better for investors to give up a little bit of return and invest on a consistent basis. And the real reason is this. When you're investing on a regular basis, you do not care that the market goes down. In fact, you want it to go down. And that consistent purchasing can sort of completely change your viewpoint of the market. And I think once investors realize that a down market is not so bad, then they're less likely to panic. They're more likely to ignore all the talking heads on TV. They're less likely to do the wrong thing. They're less likely to trade, and they're ultimately going to get pretty good performance. You may give up 0.5% over 50 years by not investing at all on day one, but all it has to do is prevent you from making one mistake, and you'll make back that amount that you're missing very, very quickly. So we really are trying to stress to people that investing should be a regular discipline, and you don't have to time the market if you're doing it on a regular basis.
Yeah, absolutely.
Another question is someone's basically looking for a dividend ETF recommendation from you.
That's a little tough because I actually have a bit of a problem with the way dividend ETFs are structured. So just real quickly, I don't want to get into a lot of detail, but ETFs like CDZ and CUD, the problem with these ETFs is they tend to be yield weighted. So the higher yield stocks will tend to have more weighting in the portfolio. So it's not based on market cap or the yield of the stocks. I think SDY would probably be more where I'd be looking at if I was looking for a dividend ETF. But the Canadian dividend ETFs, I'm not a fan of personally.
Okay. We've got a great question about many Canadian companies are international in scope and sales already, and doesn't this corrupt the idea of geographic diversification? Referring to Bank of Nova Scotia, for example, has significant business outside of Canada. Absolutely. I mean, this does depend on what Canadian stocks you're buying. There are companies like Magna, BNS, Bombardier, of course, have international operations and have a big part of their business outside Canada. So if you wanted to have a 30% international component in your portfolio, just take a look at your Canadian names, and if you're of the view that a lot of them are internationally already, then maybe you can take that 30% down to 15 or even 10%, because you've already got some international exposure. So it's a great question, and it also underscores the fact that you do have to look at your portfolio as a whole, but also as well as individual names.
Yeah, and I just interject that a lot of the U.S. companies, of course, which are huge market capitalization compared to Canadian companies, they are, in a sense, many of the big U.S. companies are gigantic multinationals that just happen to be domiciled in the U.S. So I mean, Coca-Cola and McDonald's, or even Starbucks now, are companies that come to mind that fulfill that.
Yeah. Okay. We've got a question. I can address this. They're basically looking for 3 or 4 dividend stocks, and so we've taken a look at Auto Canada, which is, a lot of people consider it to be a small company, but it's 1.5 billion in market cap right now. They've raised their dividend 13 times over the past 13 quarters, and it's just the stock's done very, very well. But from a dividend aristocrat type of point of view, where they keep raising dividends, it's a pretty solid name. Stantec started their first dividend in 2012. They've raised it twice since then. It's an engineering company. If you drive around Ontario, you will see their signs on all sorts of construction projects. There's a company called Boyd Canada, which is continually raising their dividends. It's an auto repair company that they do collision repair and glass repair and things like that. Those are on the smaller scale. If you want to have a larger, safer, more utility type holding, I would take a look at Fortis. Fortis is a utility that's raised their dividend 41 years in a row, so it's pretty hard to argue with that type of performance. and even one of the companies I used to work for, CI Mutual Funds. CI Mutual Funds is owned 35% by Bank of Nova Scotia. They do not want to be bought by Bank of Nova Scotia, and so they continually raise their dividend to try and increase the value of the company, so it makes it harder for BNS to buy them out. So they report tomorrow, and wouldn't surprise me at all to see another dividend increase tomorrow from CI Financial. All right, Avram, there's a one question. Isn't it better to just buy 5 to 10 dividend stocks rather than a dividend ETF? So.
Well, I mean, it depends. Look at the top 10 holdings in the ETF and see if you know you agree with those holdings. Like if you were buying XIU or XIC, you know, I don't think there'd be much risk in that. I wouldn't be buying CBZ where it's got, I don't know, Artis and Artis Reed and AGF Management just to get the yield. But yes, you can certainly buy 10 or 15 stocks on your own and save. I mean, you know, the ETFs tend to have a low MER, but nonetheless, I'm always a fan of, personally for me, I prefer to actually buy companies directly rather than an ETF. So it really depends on the ETF. I think with XIC and XIU, these kinds of ETFs, I don't think you really need to worry as much as with the smaller ETFs that are more specialized. So I guess just going for the plain vanilla ETF would be the route I would go. But again, if I had the money, why buy the ETF in the first place when I can just buy the stocks directly?
Okay. And then we have a question. I'm not sure if I can answer this. It's, does my dividend strategy change if I'm utilizing the Smith maneuver by borrowing money on my mortgage?
Gosh, I don't think I want to go there because that's kind of getting into you know, personal advice that somebody should be talking with their planner or accountant. So especially when you know, you have your house as collateral.
Yeah, I guess it's effectively trying to get the interest deductibility because you're investing, as opposed to the interest deductibility on your house, yeah, which you can't deduct in the States, but you can deduct it in the U.S. But in Canada, again, anytime you add any sort of debt to an investment strategy, it gets far more into a personal scenario situation as opposed to a general commentary. So it much depends on your income, your net worth, your assets, your risk profile, and your degree of panic if the market actually goes down. So it's, yeah, it's a pretty wide topic.
Yeah, I mean, that's a personal decision that people need to make themselves and get proper advice on when you're talking about using your house as collateral.
Okay. All right, well, I guess we should wrap it up. We've gone a little bit over, but just wanted to thank Avrom. Thank you very much. And his site is the Dividend Ninja, and he'll be posting the presentation on site. And both at 5i Research and Canadian Moneysaver, we will as well. If you didn't get your question answered, feel free to send us an email at moneyinfo@canadianmoneysaver.ca, and if you want to let them know your email address for questions as well, Avram.
Yeah, absolutely. It's just ninja@dividendninja.com. But I thought what I do is I just do a quick post, and then you know, readers can put their questions on that post as well, and then maybe you and I can answer them as well if you like.
That's perfect. That's great. Well, thank you, everybody, and thanks for attending.
Yeah, and thank you, and thank you, Peter, for organizing.
No problem. It was fun.